Welcome to Manaf Speaks Finance. My guest today is Faisal Khan from Sedulo Commercial Finance Funding. He's the commercial finance broker, and I've worked with him for a number of years. He's an amazing guy, and so I'm really privileged to have him here today. So, Faisal, thank you for coming
No,
down.
you're most welcome. You're most welcome. And thanks for having me
So,
on. We've been talking about this for quite some time now, and I'm pleased that we've finally managed to pull it off and we're here today. So, yeah, I'm looking forward to it.
yeah, so it's been, like I said, it's been some time to get the dates right. So you're a busy man. So obviously, to get you here has been a challenge. So thank you.
But we're here now, so I'm looking forward to it. Yeah, this is my first podcast, so be gentle with me. I've never done this before, so I hope it goes well. I'm sure it will.
Definitely, don't worry. I mean, I'm not a scary person. So, again, let's obviously, you introduce yourself to the, the viewers. So, how did you get into the finance sector? So, in terms of, commercial finance. So, just talk about yourself.
Right from the beginning.
Yeah.
Okay, yeah. So, well, you and I have been working together for quite some time, Manaf, during my commercial banking days at NatWest. If you go all the way back, I graduated, went to university, got my degree in accountancy and finance originally, and at the age of 21. And after that, I was deciding what I wanted to do. So I thought, do I want to go into accountancy or do I want to try something different? So I got an opportunity to work at NatWest Bank at the time. Started rock bottom as a cashier, but it worked out really, really well for me working for NatWest. So it was supposed to be a little summer job whilst I decide what I wanted to do.
So it's always a position where you start, and obviously starting is always going to be at the bottom.
Yeah, absolutely. Yeah. So I wanted to start somewhere, get some experience in a big corporate organisation. Got into NatWest Bank. It was supposed to be a very short sort of term. Okay, let's see what it's like, and eventually I'll probably change my mind. But it ended up being a 21-year banking career in the end, which is brilliant. I moved up at NatWest pretty quickly, did really well over there. Within the first 3 years, I became a branch manager. I was branch manager for the NatWest at Bingley. Then I became the branch manager for the NatWest at Greengates. And then 5 years after working in retail at the bank, I then decided to move into business and commercial banking. And that's when I became a relationship manager. And I was looking after a portfolio of SMEs throughout West Yorkshire. And then I did that for the next 16 years of my career in NatWest. And
amazing. So there's so much opportunity within the actual banking firm of NatWest. Yeah.
So I had a wonderful banking career, built some really strong networks with people within the bank and also externally as well. Got the opportunity to work with some really, really wonderful people, learn a lot about banking, about finance, about property, about credit. So that's where I got all of my knowledge. And then fast forward 21 years, I got to the age of 42, and I thought, right, okay, I've been here for half my life now, so what do I do now? So I decided to have a bit of a change in my career, and because the one thing that I was always really, really passionate about throughout my banking career was supporting businesses through finance. And the actual lending money side of things was something that I always really, really enjoyed. So that's something that I thought, okay, maybe I can focus on this now and explore the world of commercial finance brokerage. Okay. And this is when I looked into Sedulo. Now, Sedulo are a business advisory firm, one of the fastest growing business advisory firms in the UK. They do all kinds of great things for SMEs, accounting, audits, and commercial finance, along with wealth management, forensic accounting, R&D, all kinds of great things. Commercial finance is where I come in. So as commercial finance managers, commercial finance brokers, we have a panel of lenders, we're all of market brokers, and we're out there, and hopefully we can do things where a lot of high street banks may not have a great appetite. We have lenders that have got a huge appetite to do things for businesses where maybe they've been turned down or maybe they've been unsuccessful in terms of getting funding through high street banks. We can get in there and we can really support them with their aspirations.
So that's a huge change from one bank offering just one product to actually going to a commercial sector.
That's right.
Where, it gives you a whole opportunity of different providers.
Absolutely, yeah. Look, I spent 21 years working in a high street bank, and it was a great place to work, and great employee, great culture. But then, you're just working with one lender there, and where they do a lot of great stuff, their appetite for some stuff is not as great, and we all know that. High street banks are great at a lot of things, but then there's other lenders out there that can do other things that high street lenders can't do. So I just wanted to, because I was so passionate about supporting the local business community in West Yorkshire, that I just felt that there's more that I can do. And if I had a panel of more lenders, I'll be able to support businesses in more ways that I can by working in a high street bank. And I've been working for Sedulo now since June last year, so it's been 7-8 months now. And during that time, honestly, Manaf, the kind of things that I've done for businesses I probably wouldn't have even dreamt of doing whilst I was working in a high street bank.
Well,
which
definitely
is
I can agree with that. Obviously, you've helped quite a number of clients that were in the problem, that needed finance funding, whether it's quick finance, long-term investments. So obviously, you've come out and you've dealt with it, and you helped them out. So sometimes it's not always successful, but again, most of the times, it's been there.
We'll try our best. We'll try our best. Yeah.
So, looking at the type of fundings or the type of things that you actually get into. So, in terms of, let's say, talk about commercial finance.
Yeah.
So, what can you tell us about that? So, what is it first?
Okay. So, look, the thing is, when I say I'm a commercial finance expert, I will lend to businesses, any commercial organization. For the only thing I don't lend is personal loans and regulated lending, regulated mortgages, things like your own house, your own domestic property where you live yourself. I won't do that because I'm not CMAP qualified lender. Apart from that, any other type of commercial finance, we can do, whether it's commercial property, whether it's asset finance, whether it's invoice finance, whether it's bridging finance, development finance. So we can be more specific and go into some of those types of finances just so that you've got a better idea.
Okay.
So let's talk about commercial finance first of all. Okay. So under commercial property, a lot of my work is actually property work, and the reason for that is because whilst I was at the High Street Bank where I worked before, majority of the work that I used to do was commercial real estate finance related. So a lot of people have known me to support them on that area, which is why a lot of the referrals that I'm getting at the moment are commercial property side of things. So under commercial property, mainly you'll have your clients, businesses that either are looking to purchase a commercial premises for their own business, so owner occupied, or you'll have the investment side of things where, like a buy-to-let, for example, where you're purchasing a property for investment purposes. Okay, the criteria for both is quite different. Okay, so if you want, I can maybe just go into
Yeah, so let's say there was certain examples that we come across with certain clients. Someone who's an owner, occupy a business.
Yep.
So if they're starting afresh, so there are some challenges if you've not had any history before.
Yep.
So is it easy to get the finance for those people who are just starting up?
Okay.
How easy is that?
Okay, so that's a great question, Manaf. Okay, so look, the thing is, let's just be very open and honest over here. Lending money to an established business who's been going for over 3, 4, 5 years, who has got a set of financial accounts, so they can go to the bank and they can prove that this is what the business is doing. This is how much profit I'm generating. This is my turnover. This is my balance sheet. Lending to that for any bank will be a lot easier because there's track record there. There's consistency. They can see what are the chances that this guy can repay this loan back. Okay. Where a business is starting from scratch, that's always going to be a challenge because obviously they've never traded before, so we don't know whether this business is going to be a success or whether it's not going to work. Okay,
so it's a high risk.
Yeah. So any new startups will always be a high risk proposition for any lender. Okay, some lenders have got a much stronger appetite for that kind of stuff. They're set up for that particular purpose. Some lenders have just got no appetite for that whatsoever. So that's kind of where the job of a broker is to kind of know which lenders are the best people to go to, okay, to meet the client's requirements, okay. Typically, going back to your question about new businesses who are looking to purchase, so you're talking about typically a business who just set up and they want to buy the property at the same time as well.
That's right, yeah. So just say example, someone who's setting up a business, whether it may be a restaurant or a cafe or any sort of business where they want to acquire the premises and trade from there.
Okay.
But they've not got any track record.
Okay. Okay. So look, as an example, if they're buying a going concern, a business which has been trading for a while, and they can see that it's been a successful business and it's got 3 or 4 years accounts, that's a much easier transaction, is that, because we can see that they're going into a business which has already been trading. If they're actually setting up from scratch, from nothing, then typically the only way to do that, the lender will need to see a full business plan. So they don't need to understand on the business plan who's the guy, what's their background, what have they been doing, what's the business that they're looking to set up, and that needs to be backed up with some forecasts, so cash flow forecasts, projected financial accounts, all of that stuff.
So really they will need an accountant and a broker. to make the deal.
Absolutely. So this is where I always work hand in hand with accountants like yourselves, because we need to support the client in terms of getting a business plan together, and the lenders will look at the numbers. Okay, they're numbers people. They need to understand the non-number side of things, as in your own background, your CV, what you've been up to, what experience you've had, what qualifications you've got, who your suppliers are, who your customers are, all of those kind of things. But then it does really come down to the numbers. The numbers have got to fit as well. Okay, and that's where the accountants really, really help.
All right, that's excellent. So that's someone who's just starting up. So I presume that's a bit more harder and tougher to get loans on those sides.
Yeah,
it's not impossible, but it's possible. But obviously there's a lot more criteria to meet.
It's not impossible, but those types of deals are probably the most challenging ones. And like I've said to you, the reason for that is because they're going fresh into something that they've never done before. So it's almost like Dragon's Den, really. Okay, you're going in front of dragons and you're kind of asking for some money, but you've never done this before, or you may have some experience. So you then need to present yourself in a way. Why would I, as a banker, want to give you £500,000 or £100,000 or whatever you need? You need to prove to me that you're good for this, and you're going to pay me my money back eventually. Okay.
That's fine. So obviously now coming on to established businesses, and what sort of challenges can they expect? Sometimes can they also have some difficult situations where it's hard to get finance?
Okay.
So explain the criteria behind.
Okay. So we're still talking about a business who's looking to purchase a property for their own owner-occupied premises. Yeah. Okay. So first of all, in terms of criteria, typically lenders are around 70% loan to value. Okay, so you're going to put 30% contribution yourself, and then 70% is what you're looking to lend. Typically, what I'm finding is lenders are happy to go up to 25-year term or up to 80 years of age. Okay, typically we're looking at 5-year fixed rates at the moment as well. Okay, and we've got some good lenders out there, who are really, really out there to support businesses on that side of things. Okay,
that's perfect.
So I've done a lot of work with established businesses to purchase their own premises, or they might want to grow and expand and purchase another premises. So have property number 2, for example, or they might have outgrown their existing premises, so they want a bigger premises. So there could be a lot of reasons why
they want to get some more borrowing.
Absolutely. From an accountant side, obviously this is where I normally ask you for advice as well. Typically, what a lot of people tend to do is they might want to set up a separate property company to purchase the property, and then obviously there'll be a lease agreement in place between the operating company and the property company. Okay, so we call that an opco-propco setup.
Yeah, so I mean that's similar to what we call more or less of a holding company structure. So it just protects the assets from the trading.
Yeah, exactly.
Which can be a whole different area in itself as well.
Challenges you mentioned. What sort of challenges those businesses will face? Well, look, the thing is, if I was to simplify it down, okay, when a lender will typically look at assessing an application for a commercial property purchase, like as an owner-occupier, I try to keep it simple. I look at the non-financial side of things and the financial side of things. The non-financial side of things are things like who you are, what your background is, how long have you been trading for, what's your CV look like, what sort of qualifications do you have, who your clients are, who your suppliers are, okay, what sort of experiences you've had, what's been good, how did you come through COVID, how has the economic climate affected your business, okay, all those kind of things. So those are the kind of the non-number side of things, okay, so we need to get comfortable around
get an idea of background of the
That's right, of the actual business stuff. Then the important thing over here then is the financials, okay, and I normally say there's 2 things that a lender would look at, okay. Number 1 is security. Number 2 is affordability. Okay, when you're buying a property, the security element is pretty much taking care of itself anyway, because the lender will take a legal charge over that property. Okay, if it's 99% chances that it'll be first legal charge, they'll take over that property, and that security element
that's the security for
so the security element is pretty much covered just by the bank taking a legal charge over the property, and it'll be 70% loan to value. They'll so that's that done. The difficulty that we see sometimes is on the affordability side. That's where people can struggle sometimes, because people will have a vision that this is how much we want to borrow, but the financial accounts may not be strong enough for it to be able to demonstrate affordability.
So again, it could be the profit, it could be again, sometimes the businesses could be going through a difficult patch where they've got a lot more expenses in a particular year, so that the profitability will be lower. So and that can also have a serious outcome into terms of borrowing as well then.
Yeah, that's a very good point, is that, Manaf, by the way, because this is where you have people like me who can actually talk to the lenders, and we can have that conversation. This is why it's important for us to have 2-3 years financial accounts, so that we're not just basing the decision on last year's financial accounts. Last year's accounts might be a little bit weaker compared to the previous 2 years accounts.
Yeah.
Okay, this is where a lot of the lenders that I'm working with are very open to have that conversation. Okay, and there might be a very good reason why they've had a weaker year this year compared to the last couple of years. Okay, so typically what I tend to have with lenders is they might have had a couple of one-off expenses this year. Okay, I had an example recently where a client wanted to borrow some funds, and the turnover was a couple of £1 million, healthy business, very healthy balance sheet. Okay, but this last year they had some losses, unfortunately. Okay, and they were importing from overseas. So unfortunately, last year, the reason for that was because the shipping costs last year went out of the roof.
Yeah.
Okay, so that was a one-off problem. That now things are back to normal again, and the business is back on track again.
Yeah. And the thing is, if they went directly to the lenders or to the banks, then they would just do a tick exercise, and they may not, get through that affordability.
Quite possibly, possibly.
So
When I was a bank manager,
you do the same thing, tick, and then that's it.
Well, actually, to the opposite, I was actually quite thorough, and I made sure that it depends who you're sat in front of. Okay, so some people are, it's a tick box exercise, or it's computer says yes, computer says no. Okay, personally, the way I've always worked is I sit with the client, whether I was in the world of banking or now as a broker. And you really need to understand and get underneath those numbers. Look, the thing is, the accountants will put the numbers together, but then behind the numbers is a story, isn't there? So you need to understand what the numbers mean.
So the whole idea is that someone like yourself, they need that because obviously you can actually help to get that the funding through as well.
Yeah.
With your support, so obviously it makes it much more easier for the clients to engage.
Hope so.
With the,
that's the idea. That's the idea. Yeah. So, that's the idea. Because the thing is, it's what I've been doing for several years. So I've got hopefully a good idea of what good looks like, and and it's not just a case of just doing it for the sake of getting it through. We really want to support the businesses, and I have a relationship with the banks, so I can speak with them, and then the banks don't know the client from Adam. I know the client, I know their background, so my job over here is to kind of communicate the story to the banks, to explain to them that why is it that this year there was a loss compared to the last couple of years. There's a few one-off expenses over here that they've incurred, which we can add back into this, okay? And then the next stage from there, the bank will say, okay, fine, so if that's the case, you show me accounts for year ending April 2023, okay? We want to, if you're saying that they're back on track again, can you go to the accountant or whatever and get some management accounts, get some MI from then up until now, so we can see what you're saying is true.
And just to add that on there, if the clients need to have this management accounting, then therefore they need to really have a look at their real-time accounting as well. So I just stick that in between there as well. So sometimes the information is available, so therefore you can struggle as well.
But Manaf, you know what? Honestly, you and me, we always talk about this. It is so important. If you want to grow as a business, okay, keeping on top of things like that, real-time accounts, having the right professional people in place, the right setup in place, that's crucial, is that. Otherwise, what will happen is you'll go to a bank because you want to grow, you want to borrow some money, your accounts, your documents are not, your affairs are not in order, you're going to struggle.
So now let's look at in terms of anyone who's looking for investment. So in terms of buy-to-let properties, so they've got a certain surplus cash available. So what sort of criteria, again, strategy would be best suitable for these people?
So we have commercial investment, then we have buy-to-lets. Buy-to-lets is where you're purchasing a residential property for investment purposes. Okay, the criteria for that is very similar to a commercial investment. The only difference really is that with residential, you've got ASTs, short-term tenancy agreements, which are typically 1 year long. With commercial property, there's a lease in place. Okay, typically banks would want to see a minimum of 5 years. Some banks might want to see a little bit longer. Okay. With your residential buy-to-lets, typically you're looking at 25% deposit, 75% loan to value. Okay. With your commercial investments, typically what I'm seeing at the moment is around 60% loan to value, 40% contribution. Okay. The idea is the same, but just depending on the type of property.
You need to put more into a commercial than you do with a buy-to-let.
That's right. Yeah, exactly. So with a commercial investment, like I've said, you're looking at 60% loan to value. If you go back to the owner-occupied sort of example, some of the things are quite similar. Once again, if you really, really kind of simplify it down, you're looking at security and affordability. Okay, so the security for a commercial investment property obviously is going to be the property that they're looking to buy, so the bank will take a legal charge over that. That'll be the bank security. In some cases, they may even look at taking a debenture of the company as well. Okay, so that's the security side boxed off, and then the affordability. So on an investment property, the affordability will come from the rental income that you're going to generate from that particular properties.
Because, like I said, a lot of people that we talk to and they want to go and buy back to that property, they're always looking at their own personal income. So which then sometimes puts them off because with the personal income, the affordability isn't there.
Yep.
But you just touched up on that, so saying that obviously the lenders will look at what the rental income is coming from the buy to let.
So that's a great point, is that, and I know why you mentioned that, because you and I worked on a recent example just now where we were looking at a buy to let proposition, and you would like to think that, okay, for affordability purposes, the rental income that you get from that particular property should be sufficient, and 9 times out of 10 that is the case. Okay, but some lenders can go to the next sort of level, and they can say, okay, there's a minimum criteria here that the actual applicant needs to have a personal income of X amount as well.
And then talking about that, obviously, how many owner-manager companies will actually have a salary of that much as well? So generally, you're expecting directors on a minimum wage, although they may not draw down the dividends, but if they do, then that's obviously classified as an income on the self-assessment. So,
but having said that, Manaf, to be honest with you, when it comes to commercial investment property, generally speaking, I don't normally see that challenge. With most lenders that I'm working with, it is a case of, right, okay, how much rental is coming in? Is that rent? And they have a criteria, they have a multiplier, okay? And every bank is different, although they're quite similar. What I find is, with my experience of working in high street banks, their affordability criteria is higher compared to the other non-high street banks that I'm working with, okay, which is why a lot of the times I find that it's a lot easier to get the deal through a challenger bank compared to a high street bank. But
so as an example, and so obviously we can understand, say, the numbers behind it. So if you're going for a buy to let, so just say the property is maybe 500,000. So what sort of deposits and
so £500,000 property purchase, for example. And look, the thing is, Manaf, we're talking about buying a property. Don't forget, it's not about buying a property. They may even own a property unencumbered, as in, I'm going to explain the difference over here. A lot of people, when a property has no mortgage, people say it's freehold. Okay, no, it's unencumbered. Okay, freehold is a different thing altogether. Okay, so when a property has no mortgage on it, that means there's no legal charge on that property. For many banks, it's unencumbered. Okay,
right.
So property is unencumbered. It's worth £500,000. They own it on their own name. They want to release some equity out of that property and use that money to do whatever they want to do with. 9 times out of 10 is to use that money to go and invest in another business or to purchase another property. I do a lot of that. Okay. Right. Typically, for anything like that, you can go up to 75% loan to value.
For the existing investment property.
It depends on the type of property. If it's a resi buy-to-let, for example, okay, you can go up to 75% and stuff like that. Okay,
and that's a quick injection to go on fund your next project.
Yeah, absolutely. And okay, talking about quick, you mentioned the word quick there. Yeah. Okay, so look, a typical mortgage, whether it's a commercial property or a residential property investment, it can take a minimum of 7 or 8 weeks for that to complete. So depending on complexity, it could take a little bit longer, sometimes a little bit less. But what I'm finding is that's kind of like around 8 weeks is around the average time, okay? But some people can't wait that long, okay? Which is why they need to find a quicker solution. There might be an auction deal, there might be a property which is going to go pretty quick, or the vendor wants to complete within a matter of 2 or 3 weeks. So that's where the applicant needs to hurry up. They need to act pretty quickly. So I've worked on various solutions for that as well. Bridge and finance is a very, very popular solution in those kind of scenarios. Whether it's to actually purchase the property, or once again, you may already own the property and there's lots of equity in that property, and you just want to release some money from that property pretty quickly to use those funds to go and invest in another property or whatever. So yeah, bridge and finance is again another great solution that I've helped people with. Another solution I'm going to touch on is a revolving credit facility, or a funding pot as we call it as well. I've done that for a few clients. I'll give you an example. Typically, one of my clients was a property investor. He had a portfolio around 20 properties, not a lot of mortgage outstanding whatsoever. Okay, I think he had probably around about across the 20 properties, around £5 million worth of equity in there. Okay, but what he wanted to do was he wanted to grow his property portfolio pretty quickly. Okay, so he wanted to have, so he's got all these assets, but not a lot of cash. So all his cash is tied into his properties now.
Well, that's where all the money goes in.
Yeah, exactly. So he's got a lot of cash, about £5 million tied into these properties now. But he wants to grow. He's a young lad. He's in his early 30s, late 20s, and he's done very, very well on the property side of things. Mum and dad helped him out a little bit as well as a family, and he's looking after that. But now the kind of properties that he's buying are kind of your £100,000, £120,000 properties. Okay, so he wants to have a facility where if he sees something, he's not messing about with an 8-week sort of 6, 7, 8 week application. He wants to be able to have the money pretty quick, so he's got the cash and you can just go and you can purchase that property. So that way you can go to an auction, you can
get the best deal then.
Exactly, absolutely, because he's got the money. Okay, so how do we do that? Well, what I did was I put a facility in place for him. I took a legal charge over 5 or 6 of his properties, which gave about £1 million worth of security overall. And against that, I think it was a £700,000 facility that I put in place for him. And that was just there, like a floating facility. Okay, he's got it there. He hasn't drawn it down, but if he needs it.
Well, it's like considered like a working capital.
Yeah,
so
exactly.
You can draw that down anytime.
Almost like an overdraft facility. Okay, and it's there in the background. He's seen the property, he's gone to an auction or whatever. Within 24-hour notice, he'll have that money in his bank account and he can use that money then to go buy that property.
So this is quite appealing for those who've got large portfolio of
Absolutely,
properties.
100%.
And if they're cash strapped, then this is probably the best solution for them to be able to expand, should they wish to do that.
Yeah. So for a property investor who's looking to grow, who's got a lot of cash tied in his properties and is willing to provide that as collateral to the banks, that's something that we can absolutely do for you. So going back to bridging finance, once again, bridging finance is a great solution where, once again, typically it could be an auction or... I mean, I've come across various reasons.
The majority is always auctions because of it's a quick sort of thing. Where within what's the time scale? Is about 2 weeks to 4 weeks.
Well, for auctions, I think auctions typically want to complete within a couple of weeks, don't they? Well, I think 3 weeks, or something. Bridging financing, I think the quickest I've seen complete. Well, and there's been quicker as well. One of my lenders I was speaking to, in fact, I'll tell you a story. Just a couple of weeks ago, I had a client, and he wanted to complete within 2 weeks. Okay, and I thought, even on bridging finance, it might take 3 or 4 weeks. Whilst I was sat with the client, I rang one of my lenders and I asked him, I said, listen, what's the quickest you've done on a bridger? And he said 2 days. And I thought, right, okay. And I've never come across that before, okay? Right. So I said, okay, well, I've got a client here, he wants to complete within 2 weeks. He says, yeah, absolutely, he says we can do it. Okay, so bridging finance is very, very quick. It's a good means to an end, because ultimately you're never going to be in a bridger forever. Typically, you're looking at 12 months.
I think those people who actually look at this are the ones who are looking at a property, an opportunity, and they want to grab it. They can't wait for it.
Well,
so
there's that
as well.
But there's other reasons as well. I had a meeting with one of my lenders this morning, and what they're also finding is that, going back to the scenario where you said a new business that doesn't have any track record, no accounts, nothing whatsoever. Don't forget, with bridging, let me just take a step back a little bit. With bridging, there's 2 different types of bridging that you can have, either a serviced option or a retained option. So what that means is you either pay the interest every month for 12 months. Okay, that's the serviced option, is that. Okay, so then for that you need to demonstrate affordability, that you can actually afford to repay the interest. Or there's a retained, where you pay everything at the end. So you get the funds at the beginning, and then for 12 months there's no repayments whatsoever. And
that's probably helpful for the cash flow, but not as good for at the end when you have to pay it all in lump sum.
You've got to pay it back. You've got to pay back at the end. So nothing to pay for 12 months. At the end of 12 months, you repay it back. And how you pay it back? Well, you either sell the property, or you've got savings by that time, or you typically people will refinance onto a
Refinance.
normal
Gotta get a
mortgage.
normal buy to let.
And with bridging, you can have 12 months, 18 months, 2 years bridges. A lot of my lenders are doing 2 years bridges at the moment as well. So going back to your point that you made a few minutes ago about a new business who doesn't have any track record whatsoever, and they're wanting to buy a commercial property for their business, but they're finding it difficult to get it through the lenders because they can't demonstrate affordability. And the lenders, they've got cash flow forecasts, they've got the business plans, but it's still a big challenge, okay? In that situation, and this is the lender that I was speaking to this morning, it says, yeah, absolutely, no problem whatsoever.
So they'll entertain that
They'll do bridging finance for a couple of years. 2-year bridger on that, okay? And that will give the client 2 years.
So it's not all lost for anyone who's starting.
No, exactly.
Anyway. So there are opportunities being
exactly,
to get the finance.
That will give the client 2 years to trade, to get the accounts in place for 2 years. And in 2 years' time, when it's due to be repaid, they'll have a couple of years, hopefully decent accounts to get through affordability, and then they can get a normal mortgage, 25 years or whatever, to then repay that bridging finance off.
Well, that's the perfect, ending to a nice sort of getting the finances.
And that's the thing, though, because a lot of high street banks don't have those kind of options. But now, obviously, in the world of brokerage, because we're out there and we've got so many different lenders that we can work with, we can provide those options to our clients, which I couldn't do that before.
Let's look at other type of fundings. You mentioned about credit card machine funding.
Yep.
So this is something that where someone's got they want to utilize cash
as
a working capital cash flow.
Yeah. So this is an interesting one. This merchant cash advance is what you're talking about. So on an MCA, merchant cash advance, typically how that would work.
Sorry to cut you. So what this is, that this will be most likely appealing for businesses who've got a lot of card transactions, transactions
restaurants,
coming in.
takeaways, retailers.
So for them, this is the ideal solution to get quick finance.
So it's all cash flow. None of this is long-term finance. This is cash flow. The idea is to get funds out to the client to help them with a cash flow requirement that they may have, and is repayable. Normally, is kind of paid off within 12 months. Okay, and how it normally works is the lender will want to see 6 months transactions through the card machine, what's going through their bank account, okay, through the card terminal. They'll take an average of whatever's coming through on the card machine, and then they'll decide based on whatever money is coming through every single month, okay, for the last 6-7 months, the lender will decide that, okay, based on the transactions that you've got coming in, we can approve X amount, okay? And typically for something like that, they don't generally need to see financial accounts or calculate affordability based on your.
That's just all everything that's what's going through your account.
Purely based on what's coming through the card machine. And how they normally pay it back is then once they draw down the facility, whatever's been offered by the lender,
they'll take a percentage
from whatever comes through the card terminal.
So there are so many different types of lending, which I think you can go on and on about these things.
So this is a very interesting one that I've kind of come across since I've left the world of banking. Another interesting one is VAT loans that I've come across as well. So typically this is for people that have got a VAT bill due, okay? Rather than paying the VAT bill in one go, we can get a facility approved, a very short-term 3-month facility approved, where they can spread the cost over 3 months.
So again, it's all about making it easy for the businesses.
That's right.
Helping them
with the
cash flow.
That's right.
So
making cash flow easier, taking that stress away from them, rather than paying that £50,000 VAT bill in one go, just spread it over 3 months. And then you know what? Next quarter, once that's been paid off, they can do it again.
That's right.
And we can also do that for corporation tax as well. Corporation tax is spread over 12 months instead.
That's perfect, is that. So just I think main thing is that whenever you're looking at funding, I think you've got to make sure that your credit is spot on. So we had something where a one payment missed from a mortgage, delayed by 10 days, caused a serious problem for one of the clients, where they just could not get that great deal, and they had to go to the next tier. So it makes a big difference.
Look, the thing, Manaf, is look, and I know it's not easy, especially in the current climate at the moment. We've got the cost of living crisis, fuel prices have gone up, and everything. Everything's going up at the moment. So I know people are finding it tough out there. But I know it's easy for me to say this, but I would always say that, with my experience in this sector and the amount of lending that I've done, I can tell you now, once again, it's easy for me to say this, and I know it's not easy, but you just got to try your best to keep on top of your, your payments. Keep your credit file as clean as you possibly can, because that is really, really going to help you. Don't get me wrong. On my panel, we've got high street lenders.
Yeah.
We've got tier 2, tier 3, tier 4 lenders.
So it's not all lost. Obviously, there is still a solution. But
there are solutions
what,
out there.
What happens?
Exactly. Then you're pushing down the different tiers. Okay.
Yeah.
So then you've got the higher risk lenders in that case. Then okay. But in that particular scenario that you've mentioned there, this is where once again, a broker, your friendly neighborhood broker, will step in, speak to the lender, and say, hey, look, come on. He's had one payment that he missed on this mortgage, which he oversight or whatever it was, and within 7 days he paid it again, and he has a bank statement to prove that. And if you look at his track record, if you look at his credit file, for this particular client, his credit file was squeaky clean. For some reason, whatever happened, that one payment just got missed. Okay, but then a week later he brought it back again. He paid it back, and he's back to normal. There's no reason.
That makes it.
So I had a conversation with that particular lender, and they were happy with that. So then they can proceed to the next stage, and that was okay.
So it's a happy ending for the individual.
Yeah. It's still an ongoing case at the moment. So I'm really hoping that there is a happy ending of it, but I'm sure that there will be.
Right, excellent. So again, it's been really enlightening with the information that you've actually provided, and what sort of things that are in the funding side of things. So thank you for coming down and sharing your experience in this field. So
thank you so much, Manaf. It's been a great pleasure. Thank you for having me. Okay, absolutely. If you do this again, give me a shout. More than happy to support your clients with any funding questions that you have. And thank you very much, and all the best to you.
Yeah, no, that's great. Okay.
Thank you, Manaf.
Thank you.